Okay. So this model is called Taxation Principles and Practices. This is a very important model because we have many information to discuss. So obviously taxes are topic very huge, but I'm going to try to explain very fast, because obviously we have only 2 hours, but and we have many information, but I'm going to try to explain you as simple as possible. And we're going to discuss only 3 topics in this lecture. I think that we are going to finish this lecture in 2 hours. After 50 minutes, we are going to take a break of 10 minutes. And these are the rules in the class. Please participate in the discussion. Please let me know what kind of taxes you can see in your country or in your jurisdiction. If you don't understand any topic, anything that I'm going to present you, please let me know. Or if when we finish the presentation we have any doubts, please let me know by email. And please read the presentation because it's very helpful. Obviously the presentation doesn't contain all the things, but it's an important guide if you want to know more about taxes. These are the topics that we are going to discuss. First of all, we are going to understand the principles of taxation, then what is personal taxation, and then business taxation. In the first topic is divided in 3 topics, in 3 important areas. First, we are going to differentiate between indirect and direct taxation. Then explain the principles of taxation. Here is a little bit related to history, and what are the implications of taxation for the stakeholders. And to start, I would like to know, I would like to tell you what is the concept of taxation. Basically, taxation is the practice of collecting taxes. When we are in a country, in every country, we have a organization or a government institution that is in charge to collect all the taxes, all these kind of fees that people needs to pay to the government. So when we talk about taxation, we are talking about the practice of collecting money from the citizen, from the people. Another concept is that taxation occurs when government or other authority requires a fee for a fee that needs to be paid by the people that live in a certain area or in a certain country. So with these 2 concepts, we find that taxation is an action, is a practice, is when the government institution is asking to people to collect money. Another concept, the third concept is that is an imposition of an obligatory levies of individuals or entities, or entities, because at the end individuals, only one person needs to pay taxes, or corporation, another organization need to pay taxes as well. And obviously this money is paid to the government. But this practice, why this practice is important? Because this collection, this practice of collecting taxes is important because the government use this money to do another things for population. For example, building schools, or I don't know, maybe improve some highways, or maybe pay the electricity that we find on the street. So many services. So basically this fee helps to population to have a better life, a better style of life. So for that reason, taxation is very important. And what are the taxes? Because we saw that taxation is a practice of collecting, but what is a tax? Tax is a mandatory contribution. It means that we cannot avoid this contribution is mandatory on individuals or corporation by the government. Again, we have two sides here, individuals or corporation and governments. These are the two elements to understand taxation or taxes. And as I told you, taxes help to the government to construct, to provide better public services to population, as schools, roads, programs, social security, a lot of benefits that population gets when population paid taxes. From an accounting perspective, we can find different kind of taxes. For example, the taxes related to payroll. When we receive our salary, we receive an amount, but this, for example, if we work by a bank, the bank takes part of our salary as a tax, and then the bank pays this tax to the government institution, and we receive our money and minus this tax. So this is a way that a person can pay taxes if we are talking about payroll taxes. Another is a federal or state income taxes, depending, because sometimes the money that the government receives due to the taxes can goes to federal or state way. And many taxes we can find, for example, taxes if we receive property or if we sell something. So we can find many taxes, many types of taxes. And it's important that to know when we are calculating taxes, it's important to know what is the law that governs the taxes, or depending on the territory or depending on the nation, we need to know the law, because the rate of tax depending on the country. So even we need to know the system of taxation in every country. in this slice, we can find a different kind of taxes. The most common, obviously, as I told you, the type of taxes, the rate, and the law can vary depending on the nation, depending on the country. But these taxes are the most common in general. Income tax, that is a tax that a person or a corporation needs to pay to the government only because this person or that corporation has generated income, because probably this corporation sold something and this corporation earned money. Because of this, this corporation or this person needs to pay tax. So this is the income tax, is the most common tax, but obviously we need to know, depending on the jurisdiction, what is the rate of income tax. For example, in Mexico, the income tax is 35%, or we can find another country that is less than 35. Maybe, for example, the UK, I guess, is 35 as well, 45, depending on the value of the income. So we need to be sure the rate of tax that we are going to pay depending on the country. Another tax is payroll tax, that is a percentage withheld from the employees and from an employee pays by an employer. It means that our employer can retain this part of the tax of our salary, and then our employer pays this tax to the government institution that is in charge to collect all the taxes in a country. So this is a payroll tax, the tax related to salary or wage. Corporate tax is very similar to the income tax, but corporate tax is only for corporation. Income tax is more like general, could be individual for a person or to a corporation, but corporate tax is more specific for organization or for corporation. Sale tax is a tax levied on certain goods and services, and again, it varies according to the jurisdiction. For example, when we sell, I don't know, maybe a business, we need to pay the sale tax. Property tax is when we sell a property or when we receive a land, no? We need to pay this property tax. Another kind of tax is tariff taxes. This is when a tax is when we have a certain imported goods. For example, let's think on cigarettes. We need to pay this tax when we get the cigarette, no? And for example, in the UK, the cigarettes, the box of cigarettes is very, very, very expensive, because the UK paid a lot of imported taxes to get these cigarettes. So obviously the cost of cigarettes can vary depending on the jurisdiction, but this variation is because of the tax, a tariff tax. This is an example of tariff taxes. Another tax is the state tax, that is a rate applied to the fair market value of a property in a person estate at the time of death. When someone pass away, and if this person has some properties or money, the beneficiaries needs to pay taxes if they receive this money or that land. No, this tax is paid by the beneficiary of the person that has passed away. These are strange and unusual taxes in the world. So, for example, in the past, in Egypt, they have a tax called fat tax. That is one of the oldest taxes, and this was a tax that was imposed in cooking oil. So this is a strange or unusual. Maybe Egypt wanted to avoid probably disease related to eat cooking oil. I don't know, but this is an unusual or strange, because at least I hadn't heard about this kind of tax. Another example is the Roman government require, for example, in the past, when for example, Roman government had slaves, the slaves needs to pay a tax for his or her freedom. No, imagine you need to pay tax for your freedom is crazy. During the Middle Age, this is another example, European governments place a tax on soap. And we have many examples of these kind of taxes that are placed in some products here in Europe, in the soap, and in Egypt in the oil, in cooking oil. Another example is Russian Emperor Peter the Great placed tax on birds. So another example is Canada. For example, have you seen that in Canada there are a lot of people, a lot of Chinese people. So in the past, Canada used to ask for taxes to Chinese immigrants. And the last example is Japan, that Japan put a tax on whiskey. And for that reason, a lot of Japanese people that used to sell whiskey, they reduce the amount of whiskey and combine this whiskey with water in order to pay a small tax, smaller and smaller tax, because obviously they need to pay tax for the whiskey. So for that reason, they reduce the whiskey with water in order to avoid the tax. What is an unusual tax in your country? Have you heard about an unusual tax in your country? For example, Anthony, have you mentioned? So can you mention an unusual tax in your country? Or Umit, can you let us know if you know any unusual tax in your country? Okay. Okay, Umit, sorry, I saw your comment. And Anthony as well. I did some research, and in the UK there was a clock tax in 1797. So yes, these are the kind of examples that we can find around the world about unusual taxes. So, for example, I remember that in the past in Mexico, Mexican people needs to pay taxes because they have pets, they have dogs. Another unusual tax in Mexico was because of the number of windows in every house. So Mexican pay tax if you have 2 or 3 windows, or if you have 1 or 2 dogs, they need to pay taxes. Okay, guys, so let's continue. This slide is I like this slide because it's a whole view about the tax in the world. So I got this information from the OCDE, that is an organization have many studies related to the economy around the world. So in this page, I found that around the world, the statutory corporate income tax is 23.54, and this study took into consideration 180 jurisdictions. Yes, of course, I'm going to share this slide when we finish the presentation, no worries, and even the recording is going to share in the school platform, so no worries, I'm going to share this slide and the recording. So in this study that the OECD had, we can find that on average in the world we paid 23.54 and you're welcome, Umit. Is the rate, is the average rate of income taxes, of income tax. So this study took in consideration 180 jurisdictions. So obviously we can find, for example, as I told you, here in Mexico is 35, and maybe we can find another jurisdiction with, I don't know, 20, but in general, population paid around 23, the percentage that we pay related to income tax. And Asia is the zone that pays less tax with 19.62, and opposite to this, Africa has the highest regional average statutory rate with 27.97%. So this is a very important fact because, for example, I would think that probably Europe is a zone that used to pay more taxes, but no, it's Africa. So this for that reason, I like this slide because it contains specific facts about what is happening around the world related to taxes. And in 2021, 20 countries made changes in their jurisdictions related to taxes, related to corporate income taxes. For example, in this study, Bangladesh, Argentina, and Gibraltar increased the corporate tax, and 17 countries decrease this income tax. No? For example, Chile, Tunisia, and France. Probably the reduction could be because of the pandemic situation, or maybe because another external factor. No, but I feel that the most important factor is because of the COVID situation. So I'm glad to see that only three countries increased taxes against 17 that decreased taxes. So you can find this study in OCDE. I'm going to share the link as well. And this is another table that provides a lot of information that supports this slide. So, for example, Africa, we can find that in Africa, the rate that is paid is 27, and for example in Asia 19, but for example the G7, in which we can find countries as the UK, the USA, Japan, Switzerland, they pay 26, even less than Africa. And the European Union, we can find here European Union, and many regions that are very important around the world, and that were taken in consideration to help this study. You know, at the end, we have the 180 countries. So this slide provides details about the region and about the rate of tax in every country. Okay, so now that we have discussed what is taxation, what are taxes, the important fact, the funny facts about taxes, we are going to talk about direct and indirect taxes. Taxes are divided in these three important groups. So, for example, direct tax, as the name says, is this tax that is paid directly to the government. We in this tax we don't need any intermediary. So, because this is a direct taxes, because we don't have any intermediary, is very easy to understand, and is very easy to transfer the money to the government institution in order to collect taxes. So even the jurisdiction sometimes is very easy to understand as well. So this is a direct tax, a tax that is totally paid to the government without any intermediary. And and obviously this tax is going to depend. It depend on the amount that we earn, if we are a person, or the amount of money that a corporation earns. And obviously for most of the countries used to have a law that lets exemption. For example, I don't know, if we sold a house and we earn the money to sell this house, we can apply for some exemption. For example, if we pay electricity or gas, or these expenses that are related to the cost of the house or the land, this could be some exemptions, or some things that can reduce the base to determine the tax. So for that reason, it's very important to understand the jurisdiction, what is the rate of taxes, and what are these kind of exemptions that we can have in order to pay a fair amount of taxes. Obviously, direct taxes are paid by both, by individuals or by a corporation. It doesn't matter in this tax, in direct taxes, it can be paid individually, or if we have a corporation, or if we see a corporation or a company, it doesn't matter. They can pay direct tax, in which they don't need any intermediary to pay this tax to the government. One example of this tax is the income tax. For example, if we are a person that receives a salary, we need to pay taxes. Obviously, with the employer needs to decrease this tax of our salary, and then we receive the remaining part. So maybe this tax could be confusing, can create confusion. This tax can create confusion, because, as I told you, in direct taxes we don't need any intermediary, and maybe you can think, okay, but maybe the intermediary is the employer. But no, in this kind of taxes, because it's the way in which the government can get easily the tax that we pay because we receive a salary. So in the case of income tax, even if it's a salary, if we are a person, and only a specific person, if we were a corporation, if we had to pay income tax. Income tax is a direct tax, because it's very easy to calculate this tax. We need to know the amount of our salary, the amount of our profit, then multiply by the rate, maybe consider some exemptions, and then pay the tax. So it's very easy to calculate it, and the amount of money goes direct to the government. So the government receives this amount of money when we calculate the tax, and it's easy for the government to get this tax. For that reason, income tax, it doesn't matter if it's salary or if we take as a base the profit of a corporation. Income tax is a direct tax. So, and what is the opposite? Indirect tax. Normally, in indirect taxes, this tax is transferred to another person. So at the end, the last consumer of the product is the person that pays the tax. So for that reason, is an indirect tax, because we need to transfer the tax in depending on the person that consumed the product. So it's not like, for example, in the case of income tax, that we calculate, that we multiply the amount of money for by a percentage percentage of tax, and then the government receive the money. In this case, in indirect taxes, we need to finish the whole process. What is the person that is getting the product, no? So at the end, the last consumer is the person that used to pay the tax. So probably we don't know who is the last consumer, but we will have a last consumer that is the person that is going to pay the tax. So for that reason, because it's a little bit more difficult to calculate or to know what will be the last consumer, for that reason, this is an indirect tax, because obviously the process or the time that we need to have, that the government needs to has to get this tax is longer than in the case of direct taxes. And this type of tax is often referred to in a relation to the product taxes, because they are typically paid by the consumer via an increased retail price. So as I told you, the last consumer is the person that pays the tax. And again, it's a little bit difficult to calculate it, because these kind of taxes are more related to the product instead of related to the amount of money or a specific tax, a specific rate of tax. So it's a little bit more difficult, but because we need to know the product that is going to be consumed by the last person. And okay, and these kind of taxes, the indirect taxes, normally are related to products and suppliers. The perfect example to this this type of taxes, indirect taxes, is the value added tax, or VAT. That is a percentage that is added to a non-essential goods. A non-essential good could be, for example, alcohol, or could be, I don't know, maybe a plane ticket, or maybe could be another product that is not essential. Obviously, the rate of VAT is going to be different depending on the country again, and obviously, probably in one country, I don't know, one product could be essential. For example, I don't know, maybe oil, could be essential, but maybe in another country, and this product is not essential. So depending on what the jurisdiction consider that is essential or is not essential goods, and depending on that is the rate of the VAT. Maybe some clothes is not essential for some countries, but is essential for another countries. So it's important to know the jurisdiction to see or to know the percentage and the kind of goods that in which can find the value add tax. So till here, I feel that is clear to see what is a direct and what is an indirect tax. So these are the most common examples, but obviously we can have another examples of indirect and direct taxes. Okay, Eleanor, thanks to let me know that is clear. For example, here in another example in direct taxes could be the taxes that the employers paid in order to have benefits related to national insurance. For example, this could be a direct tax, in order to have social security benefits. So sometimes in some countries, the salary that we receive is decreased, one because the income tax, another because we are paying these social securities benefits. So these kind of taxes are related to direct tax, because we are paying we are paying this tax to the government, and it's easy to calculate it. So the reason could be an example of a direct tax. Or as I told you, indirect tax could be the amount, the rate that some jurisdiction pays. Some jurisdiction paid because of the cigarettes, because at the end, I don't know if it's an imported cigarette. We need to know what is the last country that get this cigarette in order to pay the tariff tax. So this could be another example of indirect tax. So remember, direct tax are easy to calculate, and we don't need intermediary, and indirect tax, we need to know the last consumer. So let me check the time. So okay, let's stop here. We can take a break of 10 minutes. Then I'm going to continue with this slide, principle of taxation. So let's continue before after 10 minutes. So in 10 minutes, let's continue. So go for a coffee or a water or a cup of tea. So let's see in 10 minutes. Okay, these are the most common principles of taxation. These principles are a kind of a guideline in order to advise governments to create a system of taxation. So these principles, these 4 principles, were created in the 19th century by the economist Adam Smith. I am pretty sure that you have heard about Adam Smith, that is the father of the economy. So Adam Smith is a very important author. So Adam Smith created these 4 principles of taxation, that the main objective of these principles is systematize the rules in which the governs create the system of the taxation. So the government needs to think in these principles when they decide to create a new tax or a new system of taxation. So this Adam Smith divided these principles in 4 categories: equality, or some authors used to call this principle equality as fairness; certainty, convenience, and efficiency. These are the 4 principles of taxation that created by Adam Smith. Obviously, this principle have been changed through the years, but these 4 principles are the base of the taxation. So equality and fairness is the principle that says that the amount of money that a person or a corporation pays to the government needs to be in proportion of the income that the person of the corporation received. If the corporation received a huge amount of money, obviously the tax that this corporation will pay will be high as the profit that this corporation generates. This is the principle of equality or fairness. Certainty is more related to the time, the manner, the quantity that the taxpayer needs to give to the government. So the time, the manner, the quantity, the way, the process needs to be very clear to the contributor and to every person in order to have a health taxation system. And so, and the third principle is a convenience. That convenience is more related to the moment. The moment in which the contributor pays the tax needs to be the ideal moment for the taxpayer. If we imagine a land, for example, and probably we have a harvest. Probably the most convenient moment for the person that is waiting for this harvest could be the time in which that this farmer can generate income because of the harvest. So this is the correct moment. So the tax needs to be paid when the farmer gets the income or gets the product of the harvest. So this is an example related to convenience. The taxes, the taxation system needs to be convenience. And the last principle is efficiency. Normally, a government institution, they have certain process in order to collect taxes. So obviously this process has a cost. So if we compare the cost of the process to collect taxes and the tax needs to be higher. The process, the cost of collecting taxes needs to be cheap for the government institution, because otherwise it's not efficient. So obviously efficiency could be because it needs to helps to the economy as well. So basically this is a principle of efficiency. But what are the implications of taxation for the stakeholders? One of the implications, or maybe the most important disadvantage when we pay taxes, is that we have a reduction in our income. If we have earned, imagine, 100 pounds, and if we pay taxes, probably we won't receive 100 pounds, we will receive 70 pounds. So this is the most important disadvantage, and this is one of the implications for the shareholders when we pay taxes, no? That our income is reduced because of the tax. But in a positive, one of advantage of the tax is that if we want to maintain the existing standard of living, we need to pay taxes, because the government needs to have this money in order to create better condition in our current life, as I told you, like electricity, or maybe in order to have a clean streets, maybe to have a better school. So if we want to maintain a good standard of living, we need to pay taxes, and this is an advantage of taxes, that we are contributing, but in the same time we are receiving a certain standard of living, no? Probably in some countries this standard is lower than in the other countries, but it's mandatory to contribute to the zone or to the country in which we are living. And another I will say advantage is that the taxation can influence in the volume or the size of production, and as well as the pattern of production in the economy. So taxes is a way to create is a way to create a certain trend. For example, if the government wants to reduce the consumption of drugs, that they could increase the rate of taxes, no? Maybe this is a measure to reduce the drugs consumption, and in order to have maybe a healthier population. So through the taxes, governments can create certain tendency or a certain trend, as in the example, like in drugs, in drugs or certain products consumption. And another implication of taxation is that because of the money that the government received because of taxes, with this money, most of the governments create projects as schools, or maybe roads, maybe highways, maybe many things that the government could create, that the government could develop a new product, new projects. And because of this, the rate of the employment could increase. So if the rate of employment increase in a country, obviously the economy is better. So because now the government has the money to create many projects and to offer employment to many people. So basically, these are some of the implications of taxation for the stakeholders. Some of these are advantage, some of them are a disadvantage. So we finished till here the topic number 1, and that was a kind of introduction of taxes. And then we are going to talk about the personal taxation, and we are going to understand different kind of taxes, or at least the most common taxes. The principal tax, as I told you, is the income tax. And related to income tax is national insurance requirements for individuals. And remember, in this part, we are talking about only individuals, only one person. The term income tax refers to the type of tax that government impose on income. Only because we receive income, we need to pay this tax. Normally, this tax is paid every month, and after 1 year, we need to calculate the annually income, and then we can determine if with the monthly payments that we made related to tax. For example, if annually we need to pay £100 and every month we paid £10, we need to, at the end, if we pay, for example, £10 every month, at the end of the year, we will have £120 that we pay because of taxes. And we need to calculate annually. If the annually calculation, we get that we need to pay only £100, the government institution, we need to give us these £20 that we pay extra. And opposite, if we pay obviously every month, I don't know, £90, and in the annually calculation, we discovered that we would need to pay 100, we need to pay the 10 pounds in order to get to these £100. So even when in salary, we are paying every month an amount of money related to taxes, we need to do an annual calculation in order to know if we pay extra or if we need to pay more taxes. So, but basically we need to do annually calculation at the end of the year. And consider these monthly payments that we do during the year, that we pay during the 12 months of the year. And this personal income tax is a tax that we can find in wage, salary, and in another types of income related to salary. And obviously this is for individuals, but in the case of corporation, obviously they need to pay this amount, not considering the salary, the corporation, they need to consider the profit or the loss that this corporation have at the end of the year. This is a whole picture in the case of the UK, talking about individual. This is kind of bands that the UK has in order to know what is the tax rate that every person needs to pay according to the amount of money that every person earns. For example, if a person earns less than this quantity, 12,000, this person doesn't pay any tax rate. Or for example, if we are earning, I don't know, maybe 40,000 pounds per year, we need to find the band, for example here, and we will be paying only 20%. So this is the bands that we can find in the UK. Obviously, this kind of bands, we can find this kind of bands in every country, but obviously the amount of money of the band is going to change, and probably the tax rate. But in general, currently, these are the bands that we can find in the UK. This is all related to income tax. But what is a national insurance requirement? National insurance contribution are another kind of taxes that we can find in related to earnings and incomes that we receive as employees. But this type of contributions are paid by the employers. So imagine if in an employer, and an employer that has employees, because of the fact that this employer has employees, they need to pay this national insurance in order to protect the employees. So this national insurance is, for example, the state pension or the maternity allowance. This national insurance talks about all the social security benefits that employers need to pay only because of the fact that they have employees, and because they need to guarantee a protection for the employees that they have, that the employers have. And who pays the national insurance in the UK? Normally, if is an employee that is 16 years old, they need to pay this national insurance. So this national insurance is divided in two. One is paid by the employee, and the other the one part is paid by the employee, and the other part is paid by the employer. So both are paying this national insurance. And if we have a person that is 16 years or over this age, this person needs to contribute with a national insurance requirement, and obviously the employer needs to pay the other part of the national insurance. Another requirement is that an employee that is earning above 190 per week, if we have a person that is earning this amount or more than this amount per week, then they need to pay national insurance. Again, they need to pay one part and the employer another part. Another condition or another point that we need to know to consider if we need to pay the national insurance is imagine a self-employed person that is making a profit about 6,000 pounds per year. This person needs to pay national insurance tax. So these are the three characteristics or the three requirements that we need to consider in order to pay national insurance. So again, these national insurance requirements are related only with the individual, with the person. We are not talking about corporation. These are national insurance is related to one person, one employee, one individual. Another kind of tax that we can have in many jurisdictions is the inheritance tax. Inheritance tax is a tax that is paid because of money, possession, and property as a land or maybe houses when a person dies. So obviously this tax is paid by the beneficiary of the person that has passed away. So this is another tax that not in all the jurisdictions we can find. But this is a common tax, inheritance tax, and this tax again is related to a person because we are talking about the possession or the property of one person. In the UK, these are, as in the case of the national insurance, we have some requirements or some facts that we need to consider if we want to calculate this tax. For example, in the UK, if the person that has died, the belongings of this person are valued about 300,000 pounds. We need to consider these belongings to calculate this inheritance tax. And the current rate for this kind of inheritance tax is the 40% in the UK. And this tax is paid after 6 months of the death. So remember, if we remember the principles of taxation of Adam Smith, the system of tax needs to be clear, needs to be in the moment, needs to be specific, and for that reason we can find these characteristics or these requirements that let us see in a clearer manner when, how much the tax needs to be paid. Another kind of tax is the capital gain tax. For this tax, we need to consider three things: the capital gain, the inclusion rate, and the tax rate. Obviously, the inclusion rate and the tax rate could be different depending on the country again. The formula is very simple. We have that the capital gains tax is equal to capital gain after the deduction of any exclusion multiplied by inclusion rate multiplied by the marginal rate. But what is a deduction or what is an exclusion? So if we see this picture, a deduction or an exclusion could be the cost. And if we sold something that we need to pay this capital gain tax only because of the fact that we are receiving money. So, but we need to consider this exclusion or this deduction. And one deduction could be the cost that we pay to get this product or to get this thing. So it could be a deduction. So basically, if we have this deduction, the base of to determine the tax could be the price that we pay for this product, the profit that we made to sell this product minus the price that we pay for this product. It means the cost. So obviously we need to consider these two things in order to calculate the capital gain tax. And if we have the amount that we received because we sold something minus the cost, we have the base of our tax. And obviously we need to know the inclusion rate and the tax rate. And if we know the inclusion rate and the tax rate, we need to multiply. Obviously, these 2 points, inclusion rate and tax rate, varied according to the jurisdiction. But obviously, we have some exemption because not all the products or not all the things that we sell, we need to pay this capital gain tax. Some exclusion, for example, in the UK, some are prepaid motor cars. If we have sold a car, we don't need to pay this capital gain tax. No, another exemption is gifts to the UK register in charities. Another is prizes and betting winnings. Another is cash. Another is if we earn something because of the change in foreign currency, we don't need to pay this capital gain tax. So again, we need to know the law related to the taxes because we need to know what are the exemption. No, not all the all the products needs to have this capital gain tax. We need to know what are the exemptions. Another things that we need to know when we are calculating individual taxes is to understand the kind of entity, in this case, the kind of person, the regime of the kind of person, because it's different if we have, for example, a person that is earning money because of a salary, or a person that is earning money because this person is providing professional services. So we have two different regimes. So we need to know the law according to the regime of the person because they can vary. And depending on the regime, we need to calculate, and these facts could vary the way in which the taxes are calculated. But the general formula to calculate any kind of tax is taxable income, is the income that we receive, minus tax deduction. And tax deduction depending on the regime of the person. For example, in the case of salaries, if we are in a regime of salary, maybe one deduction could be the expenses that we have because we receive medical services. So medical service is a deduction for the people that are in a salaried regime. But if we think, for example, in a person that is providing professional services, let's think about I don't know, maybe a lawyer. One deduction for the lawyer could be the internet, that this lawyer pays because they need to do some research. So because probably the internet is very related to the activity of the lawyer, or maybe the printer or paper, or all these kind of expenses that are related to the activity of this lawyer could be a deduction, but not in this case if it's a person that is in a regime related to salary. So we need to know the rules and the framework and the law to know what are the tax deductions, because obviously tax deduction could decrease the base in which we are going to consider to calculate the tax. And this is a table in which we can see we can consult in order to know the penalties that we will receive if we don't pay taxes, or if a person doesn't pay taxes. For example, if the payment is 30 days late, they need to pay 30% more of tax, or every 5 months they will receive another penalty. This is according to the UK government. So these are the penalties if we don't pay taxes on time. Another implications for the individuals in the case of the UK, we have a different kind of penalties. If we have, for example, income tax evasion, we can receive a fine related to money, or maybe 7 years of prison. So, or for example, we have another penalty if we don't pay VAT, or if we cheating in providing information related to our revenue. So we will receive another kind of penalty, or evasion duty if we avoid some things related to taxes, maybe provide some information, maybe don't pay on time, we will receive another fine. That this is the most important the most important fine, because is 20,000 pounds if we evade of duty of paying taxes. So you can consult this slide if you want to know more about the penalties. The penalties, again, only in the UK. This can vary according to the country. So till here we talk about the taxes that are that we need to pay if we are talking about a person, a single individual, only one person. Now we are going to talk about in general the business taxation, the corporation, and what are the regime of this kind of taxation, no? The business taxation. And to be able to understand business taxation, we need to understand two important concepts. One is unincorporated group, and the other is incorporated group. So we need to distinguish these two concepts. The first of them on incorporated group is a collection of individuals. But even when it's a collection of individuals, they don't have a legal identity. They don't have, they can't do, for example, a contract for all the individuals. They need to create a contract contract only for one of them. So even when they are this unincorporated group is a group of individuals, every member of this group has its own personality. They cannot talk about the whole group. They can talk about only as a sole individual. So one of the example of this unincorporated group could be a trust. Sometimes some individuals decided to invest in a certain financial instrument, and they decide to put their money together in order to have better benefits. But it doesn't matter that one of the person that is participating in this trust could talk in behalf of all the individuals. They can talk only because of the personal interest, even when an incorporated group is a collection of individuals. They are together, but they cannot do things on behalf of the whole group. So in order to understand the unincorporated taxation, we need to consider two stages. The first of them is because of the taxes that are going to be paid in an unincorporated group needs to be fair, needs to be equal. We need to know the earnings that this unincorporated group earn in a certain period, and we need to divide the tax according to the income that every person receives. Why? Because even when they are a group that is together, the treatment of this group is individually. So obviously the taxes that they pay, they need to be according to the earning or to the income that every person earn in a certain period of time. Another thing that we need to consider when we are talking about unincorporated group is the rules that apply to every individual. Is not the same, for example, if we think in the bands that we are talking about in previous slides, maybe for one individual, the tax rate is one, and for the other individual, the tax rate is another. So we need to know the basis of the assessment rules, and then apply this rule to the sole trader, not to the whole group, only individually. So we need to consider these two important facts. One is the tax according to the income, another the basis of the assessment, considering the sole person, the sole individual. And the other group is the incorporated group. This incorporated group is very easy. Incorporated groups, we can find incorporated groups in every corporation, because these incorporated groups have a legal identity. We can talk about Apple, Walmart, and I don't know, maybe Tesco. So obviously this kind of corporation have a board of directors, they have owners, but the whole corporation, we talk about the whole corporation, not individually. So the identity, the legal identity is Tesco, is Apple, is Tesla. So incorporated groups are all the corporation, all the brands, all the companies that we know because they have a legal identity. obviously, because they are a whole group, they need to respond as a whole group. If they need to pay taxes, the tax is paid not by by every individual or every owner of the Walmart, for example. Walmart pays only one tax because it's a whole group, because Walmart is acting as a one legal identity. And obviously, if we think in Walmart, Walmart can establish or can create contracts on the name of Walmart, but not in the case of unincorporated groups. That in the case of unincorporated groups, they cannot create only single contract. They need to create a contract for every person of the group. In the case of incorporated groups, they can create one contract using the legal identity, acting as a whole group. One example of these incorporated groups is every country that we can think, every brand that, again, Tesco, Apple, Tesla, Audi, every corporation that we can see is an incorporated group. And one of the implication when an incorporated group has one of these one implication is that incorporated taxation is kind of tricky. Why? Because obviously, let's think in Walmart. Walmart, after 1 year, imagine that Walmart received a profit, or a gain. If we consider this profit, Walmart needs to pay a tax. So obviously, accountants needs to determine this tax, and this is one of the tax that Walmart pays every year because Walmart generated a profit. Now imagine. So if Walmart decided to give some dividends to the owners of the Walmart, to the shareholders of the Walmart, obviously every owner will receive part of this profit, and because of the owner of Walmart receive this dividend, this owner would need to pay again another tax. So this scenario shows that for incorporated taxation, normally the group and the owner is paying tax, and this is a double taxation because on one hand the corporation Walmart is paying one tax, and on the other hand the owner of Walmart, when this owner receives dividends, this owner would need to pay tax again. So this is one of the implications, and this is one of the disadvantage that this kind of groups have, when they generate profits and gains. Normally they pay double tax. One generated because of the incorporated group, that is Walmart, another because the owner of Walmart received dividends. So this is an example. This is an implication when incorporated groups receive profits and gains. Corporation tax, we talk about income tax. That income tax is a concept that is general, but corporation tax is a concept that is only for companies. But basically is the same, is the tax that the companies pays because they generated income. So the calculation is the same. We need to consider the profit that the company had during a year or during a period, and then multiply that by a tax rate. And obviously this will be the tax that the corporation needs to pay. This is the corporation tax, basically. And the responsibility to pay taxes is directly to the director of the entity. Obviously, if a corporation doesn't pay tax, this corporation will receive a penalty, as in the case of personal taxes. And a corporate tax, the formula to get the corporation tax is revenue, all the income that a company receive, or all the money that a company received during the year, minus the cost of the goods sold, minus general and administrative expenses, or if the corporation have marketing expenses, or research and development, depreciation, if the company has some fixed assets, and operating costs. All these costs related to the operation of the business, we need to decrease revenue minus this all operation and cost expenses, and then we would need the basis to calculate the corporation tax. And normally when we have an incorporated group or a corporation, we need to register this corporation in the tax authority or in the government institution in order to collect taxes. In the government institution that is in charge to collect taxes. So normally we need to register the corporation. We need to provide the date in which this corporation started operation, the company, obviously the company name, the company main address, that it could be different, for example, of the owners of the corporation. Maybe the owners could be one address, but the corporation needs to have its own address, the type of business, pharmaceutical, maybe financial services, consultancy services, the type of business, in order to identify the regime. They will make annual accounts, because normally we can think that the normal period is 1 year, January to December, but sometimes it could change, and the name of the directors. And we have 3 types of tax systems. We have regressive, proportional, and progressive. Regressive and proportional are very similar, it depending on the regressive or proportional are based in 1%. These 2 systems don't distinguish the level of income, the amount of income. They set only 1%, and that's it. No, in the case of progressive, is related to the level of income. If we have a high level of income, we will pay a high level of taxes. If we have a very small income, we will pay a small amount of taxes. Another tax is the value-added tax that we talked a little bit in previous slides. That is a value-added tax. That is a tax that we pay when we consume some products. And in this tax, we can find 3 categories. One is a standard rate, that in this rate we can find all the products in which we need to pay this valued add, like for example, alcohol, depending on the jurisdiction is the rate. In some jurisdictions, 10%, 17%, 15%. Another category of value add tax is the zero rated, that is not similar to the exclude materials. Zero rated, for example, in this category, we can find books, medicine, greenhouses for crops, and is not the same in the case of exclude material, that in the exclude materials, we can find, for example, public ground transportation. No, so consider that is not the same zero and exclude materials. And if you want to know more about the percentage of the VAT in every jurisdiction, you can consult this link that I have put here. And again, the penalties in the UK have changed a little in this year. So normally, if the payments are present 15 days late, people that are living in the UK, they need to pay 4% every 15 days. So if we have, for example, one period that is a whole year, and we need to pay the next month, if we don't pay the next month, we will have 80% of the penalty, because every 15 days we will receive 40% of the penalty. So for that reason, we have here 1 month extra in this example. So we will pay a penalty of 80% because we don't pay the VAT. So this isn't the case of the UK. So we finish here.